Good morning, all, and welcome to our Connected Places Catapult SME Excellence Series, Alternative Investment. Glad to have you all online. For those that are new to our SME Excellence Series, we've put together this as part of a capacity building from Connected Places Catapult to ensure that we provide a wraparound service for our SMEs, and that could be in a variety of thematic subjects. And today we're focusing on alternative investment. So please do feel free to put some questions in our Q&A function, and we'll be able to reach those throughout the meeting. Please do a little bit of housekeeping. Please do keep your cameras off and your audio off at this time until we get into an interactive part of the session itself. Next slide, please. So just an outline of the agenda for today. As I mentioned, I'm Jay Christie. I'm the consultant for the Enterprise Network at Connected Places Catapult. We have a rich partners and presenters for today. So please do take part, and please do, take notes, and we will aim to support you as much as possible through the process. I'm going to now hand over to my colleague Yusuf Chandan, who's the investment consultant at Connected Places Catapult, to take you further. Please enjoy.
Thank you, Jade. Good morning, everyone. My name's Yusuf Chandan. I'm a consultant at the Connected Places Catapult. Could you just go back to the agenda slide, please? Wonderful, thank you. Yes, so my name's Yusuf Shadden. I'm the consultant at the Connected Place Catapult. For the last 10 years, I've been working with early stage organisations, helping them raise investment. Today, we've got 3 speakers for you that are going to be speaking about different parts of the investment landscape that are relevant to our SMEs at the Connected Place Catapult. I'm going to do an intro session which includes some trends around finance and investment, and then our first speaker is going to be Raina Lim, who's an investment specialist at the at Innovate UK. We then have Paul Latio from Mercurio Capital, who's going to be speaking about financing innovation. And then last but not least, we've got Arnaud Dutoit from WeSprint, who's going to be speaking about special purpose vehicles. And then at the very end, I'll do a quick recap. Next slide, please. So just in terms of a preface, so the content that we're going to be providing today is being provided for information. These sessions shouldn't be considered legal advice, tax advice, investment advice, or other advice, just to kind of put it out there. Before you take on investment, before you start exploring investment opportunities, it's always good to speak to an expert in these areas. So, of course, we're providing quite a bit of information to you today. In terms of the scope of our session, so our audience at the Connected Places Catapult, in terms of the people attending today, our SME base is quite broad, in the sense that we're covering a number of different vertical sectors and industries around the travel, places, built environment, which includes hardware, software, digital, critical infrastructure, complex supply chains. We have organisations, academic spin-outs at a very early stage, TRL. We have organisations with minimum viable products. We also have organisations that are more established in the market. So to provide a session to cover the needs of everyone in the group and our cohorts and our alumni is quite broad. So what we're looking to do is really, as an aim of the webinar, is to provide you with some good information, high level information, signposting to give you a better understanding of the types of investment that's out there. So about our expert speakers, Raina Lim is an investment specialist at Innovate UK, where he's been working there for almost 4 years. Paul Latio, he left his career in the city as a stockbroker and set up Mercurio Capital as a corporate finance firm helping funds. And since then, it's evolved into an international finance broker. Arnaud Dutoit is an experienced entrepreneur and investor and a long-standing friend of the Connected Places Catapult. The format of the webinar is we're going to be going through the 3 different speakers, and then at the end of each session there'll be time for some Q&A at the end of their particular presentations. But you can also pop some questions into the chat as well. In terms of the definition of alternative investment, next slide, please. So the British Business Bank define alternative investment in terms of alternative lending and debt-based products. So that's one definition. So the British Business Bank, for example, speak about asset finance. So that's different forms of leasing, hire purchase that helps businesses invest in vehicles, equipment, plant and machinery. They speak about invoice financing and asset-based lending, which is based upon using a range of business assets, including accounts receivables, stock, inventory, plant machinery, and even intellectual property to unlock capital, and alternative finance in terms of alternative finance providers that aren't your regular high street banks. They're also challenger banks. They're also peer-to-peer, and a wider range of solutions that look to meet the needs of our SMEs. Next slide, please. In terms of there's three reports that I'm referencing for this introduction trend session. The first report is from the British Business Bank, and it's their Small Business Finance Market Report 2025. The top four takeaways from the British Business Bank were that fewer smaller businesses are using external finance, but the value of that finance went up in 2024. They're also seeing that business investment is central to improving the long-term growth of businesses, but it does often require capital. The finance markets are evolving to reach entrepreneurs. They've got the potential to drive productivity, increase living standards, and also help organizations address societal challenges, including transition and net zero. So that the markets are evolving, the range of products are evolving, and they're looking to create products, and there's a need to create products to meet a wider group of entrepreneurs. And more investment is needed in the UK's fastest growing companies. Innovation, as we know, has a lot of opportunities to drive the UK economy, create employment, reduce inequalities, and also meet a lot of the factors that we're trying to meet with our organisations here. In terms of alternative finance, there's a number of different providers out there. Just picking these ones out from the British Business Bank, Evoca. So they're a lender, a small lender to specialise in small businesses. Last year, they lent £730 million across 35,000 businesses, which was a record for them. Funding Circle have also reported growth in their long-term loans. Folk to Folk, one of the UK's largest peer-to-peer lenders, they reported an increase in the number of loans that they've been providing, and also ThinCats, they reported a decrease, but they recorded their second highest year in 2023. So if you type in alternative finance providers into Google, or you look, for example, at the British Business Bank report, you'll see there's a number of different providers out there. Next slide, please. So in terms of some of the trends, when we look at alternative finance, these are some of the sources of alternative finance that SMEs in the UK are using. We can see there's a bit of a peak in 2020-21, the COVID effect, but generally it's credit cards are used the most. We've got bank loans, we've got overdrafts, leasing and hire purchase, and then grants, of which many of our organisations at the Catapult are very much grant based because of the nature of the products and solutions that you're developing. Next slide, please. In terms of awareness of alternative finance, I was interested to see that for many startups, many SMEs in the UK, there's less knowledge about business angels, and then marketplace lending, equity crowdfunding, invoice finance, VC, and then finally more SMEs and startups now about leasing and hire purchase. So in terms of one of the things that we're trying to do, and the British Business Bank and other providers, is also educate the market as well and help our startups to understand the range of potential investors and capital providers out there. Next slide, please. In terms of some investment trends from an equity perspective, if you're interested in looking at equity and you want some really interesting stats on equity, the HSBC Venture Capital Term Sheet Guide, it's a 90-page report, very detailed. It's got some fantastic information in there, and that's based upon over almost 600 term sheets that they've reviewed with legal partners and other banks. And some of the trends that I know, I picked out some of the top trends from a pre-seed and seed perspective, which is the early stage of investment. So they're seeing that the seed investment is surging. It's very competitive, and there's more founder-friendly deals available on the market now. We can see that increase from 29% to 32% in 2024. Then they're also seeing that 70% of seed investments and 59% of Series A were led by UK-based investors. So very much around UK investors supporting UK startups at that early stage. Next slide, please. We can see here in terms of a chart, just looking at the seed, Series A, Series B, Series C, that there's been an increase in growth of seed funding, a double increase from 2021. And on the right-hand side, these are some of the items that are typically on a term sheet. One of the items from a seed perspective that's changed quite a bit in the last, well, between 2023 and 2024, was the number of co-investor deals have gone down. That means that there's more investors at the seed stage that are single investors rather than going out to generate investment in a syndicated approach, which was quite interesting to see. Next slide, please. And then in terms of trends, another trend that was picked up by HSBC was that they're seeing more seed investment deals originating from the UK, or seed and Series A from the UK. In terms of average sizes of seed investment, so the sizes are about the 4 million-ish. In terms of average, valuations. Sorry, apologies. Top right corner, the top diagram there. The valuations have been an average of about 4 million at the seed stage, with an average investment size of 650,000. And then down at the bottom, two items to pick out was that over the last couple of years, there's been an increase in the inclusion of ESG and sustainability clauses, and diversity, equality, and inclusivity clauses in term sheets as well, where investors are looking for investees to put policies in place around sustainability and D&I. Next slide, please. And then finally, investment trends from Bowhurst. So Bowhurst, so last year there was the lowest number of deals made since 2015. There were 6,885 deals in 2023, 5,256 deals in 2024. 20 billion of investment was made in 2023 compared to 16 billion of investment in 2024. And as you can see on the right-hand side, we had that peak in the COVID effect, but also software and SaaS. And the trends at the moment look to be that clean tech, fintech, AI continue to go up and continuing to increase in size, but software investment has been going down a little bit. Okay, at this point, I'd like to hand over to our first speaker, over to Raina Lim from Innovate UK, to talk about the investment program. Over to you, Raina.
Thanks, Yusuf. Nice to meet everyone. I'm Raina Lim, I'm the investment specialist as part of the Investors Partnerships program. Today, going to talk to you more about what the Investors Partnerships competition is about, and also how it all came about, and happy to take any questions at the end of it. Next slide, please. So just to show even more slides, just before I explain how what is the Investor Partnerships program all about, is about the Investor Partnerships program arises because of two challenges that we are trying to overcome or help facilitate or bridge the gap. The first one of which is the funding gap, or the valley of death, as many of you know, also known as the capitalization challenge, where innovative SMEs in the UK are undercapitalized. If you look on the left, the graph by British Business Bank, it shows that the amount of equity invested in small businesses in 2023 decreased by 11%, whereas deal volume also decreased by 7% as compared to the previous year, which is consistent across the different stages of business growth. Graph on the right as well shows by Business Bank shows that supporting and financing innovation in innovative SMEs is not a linear process. Different funding and finance options alongside tailored support is really critical in the business growth of a company. And I think the very interesting part of the right graph shows that almost as many business receive support from banks before the first Innovate UK grant as they did afterwards, which really demonstrate how various types of funding across debt, grant, and equity complements one another and plays a role in the broader funding strategy in order to enable a company and SME to grow and scale. Next slide, please. And so the next challenge that we wanted to overcome was definitely the inclusion challenge, because raising capital is harder for underrepresented founders. Access to capital becomes even more difficult from ethnic minorities, underrepresented backgrounds, different socio-economical groups, and this is where investor partnerships plays a critical role to overcome these challenges. The graph on the right, as you can see, shows the number of underrepresented groups raising funds, and the graph on the left shows that both the amount of investment as well as the number of investment deals is significantly lower for all female founding team compared to, say, mixed gender teams. And investor partnerships helps to address this by enabling capital to be deployed in underrepresented areas, supporting businesses to grow and scale. Next slide, please. So following the two challenges that we discussed with innovative SMEs facing the UK, investor partnership is all about addressing those, supporting innovation and enabling access to capital required to accelerate growth and scale innovative businesses. So how it works is kind of a blended finance way. We combine grant funding, non-dilutive funding from Innovate UK, which supports a specific R&D project aligned to the scope of the competition, with private equity investment from our investor partners, which can include one or more investors. So this approach essentially helps to incentivize investors to invest earlier than they normally would, as the grant funding helps to de-risk that investment, or even to invest at all, enabling companies to access the growth capital earlier to take their technology to the next stage or reach their next inflection point to be able to grow and scale. Next slide, please. So in terms of the impact of the investor partnerships since the inception of the program in 2017, to date, until 11 April 2025, there has been 380 companies that investees or companies that have went through this program, of which 94 investors has provided aligned investment to it. We have provided 153 millions of grant committed, of which over 100 million has been deployed. Alongside this 153 millions of grant committed, 416 million of aligned investment has come into it as a result of this program, which I'll explain more later how it happens. And out of these 380 companies who raised 416 aligned investment, we have further tracked these companies who continue on follow-on investment rounds into the next round after which, and we have tracked the total investment to be 1.44 billion, which means approximately 1 billion of follow-on funding has been secured from these 380 companies that have went through the program so far. Next slide, please. So how it works is really dependent on the level of research category that a company wants to do a specific R&D project under. And the type of aligned investment and amount of aligned investment also differs on that. So as you can see here, for feasibility studies and industrial research, which is more like early stage, the grant available is 70% of the total project cost, of which the aligned investment needs to be equal to the grant funding. Just a theoretical example to showcase this, if a company were to apply for a specific R&D project under industrial research with a project size of 1 million, the grant that comes in alongside of it is 70%, which means 700,000 will be grant from Innovate UK, of which The aligned investment that needs to come from an investment partner needs to be equal to that, which is also 700,000, which brings the total funding to be 1.4 million, which, as you can see, is over 400,000 more than the project size, which really can be used for other growth-related activities that is not covered by Innovate UK, such as commercial costs, to be able to grow and scale. For experimental development, which is more toward late-stage R&D from prototype to market, the total project size is up to 2 million, but the grant available is only 45% of which, and the aligned investment needs to be twice of the grant provided. So if you're applying for 2 million under a 2 million total project size, the grant of it will be 450,000. Sorry, if you're using 1 million as an example for total project size, the grant available will be 45%, which is 450,000. But in this case, the aligned investment needs to be twice of 450,000, which is 900,000, which is bringing your total funding to 1.35 million. So it really depends on which R&D project you're putting your research category under, which determine what's the aligned investment that you need to raise to be able to be eligible for this competition. Next slide, please. So we currently have a competition that is open, that is specific to climate, clean energy and climate tech. And it closes on the 2nd of July that I'll be giving some examples of what scopes we are looking about and whether you're eligible or not. Next slide, please. So as mentioned as an overarching overview, this round focus on technologies and innovation that aims in regards to clean energy for the UK to accelerate net zero, which includes solutions and enabling technologies that make a significant contribution to mitigating climate emissions across heat, power, mobility, manufacturing, material, agriculture, and food production system. It's quite a broad list, and in the next few slides, I'm not going to regurgitate all the information, but it's just to give you some illustrative examples of what could fall under this scope. But obviously, as mentioned, it's only an illustrative list, which obviously more projects can fall under the scope depending on the specific R&D project that you want to do. So next slide, please. So the next 3 slides is really just to give some examples in regards of what we mean by clean energy solutions, sustainable mobility, so on and so forth. So for clean energy solutions, we are looking for innovations that are low cost, that improve energy security and reduce emissions. These can range from a wide range like carbon capture, utility and storage, to energy efficient and heating system solutions. And for sustainability, sustainable mobility, we are looking at technologies that reduce emission across all forms of mobility. As you can see here, that ranges from smart automated to decarbonizing freight and logistics. Next slide, please. So under sustainable low carbon manufacturing materials and manufacturing, we are looking for innovation that foster sustainable growth across industrial processes and supply chain, which includes all these categories that we have listed. Again, this is an illustrative list. The purpose of this is to give some kind of examples of what could fall within scope if a company is interested in applying for a specific R&D project. Next slide, please. And lastly, to close off, under sustainable agriculture and food production system, we are more looking towards innovation that are novel, low emissions production system or technologies which reduce emissions in agriculture, which could include low emissions fertilizer, methane reductions, technologies and stuff. Ultimately, you must demonstrate how the project aligns to the scope in the application. That would ultimately determine whether you are in scope for eligibility. Next slide, please. So what we are looking for in terms of the investor partnerships is across 3 main factors. One is we're looking for ambitious company that are actively seeking investment, that wants to do a well-defined, innovative R&D project that is aligned to the scope of this competition that I just mentioned just now. So the first key factor is the innovation and the innovativeness. We then expect these companies to be investment ready and attractive to investors, and they should have established some level of traction, which is our second main factor in terms with an investor partner. So traction, what I mean by traction is we don't want it to be early stage discussion, but more towards late stage discussion, where you're either towards the due diligence process or the term sheet has been issued, but the investment has not closed yet. That we mean what we mean by traction. And then the last part is additionality, is what does this grant do as a result? What does this grant does as a result of it from that perspective? So what's the additionality that the grant brings to the investment? And it's more towards of how much aligned investment the company brings into the investment as a result of this grant. So these are some examples of what we mean by additionality. Next slide, please. So this is how we expect a typical SME application to work. Ideally, before you as an applicant starts looking for investors, you have already engaged with Innovate UK Business Group to determine whether equity funding is the right option for you. They will then continue to help give you tailored support to become investment ready. And then Innovate UK Business Connect can help facilitate investor connections through activities such as funders meets founder events, which basically forms the foundation of the whole investor partnerships process. Once the foundation is placed, the application process starts with an expression of interest, which is known as an EOI. At this stage, the SME and the investor partner work together to complete the EOI form, which the investor partner then submits to us, the investor partnerships team. This helps us act as an initial filtering stage to assess whether the application is likely to be in scope and eligible, so that you as an SME do not waste time to put a full application unnecessarily. If the EOI is deemed suitable, we then invite the SME to make a full project application, which then goes through the normal assessment and confirmation of quality threshold. If at the same time, we also confirm the investment additionality and traction with the investor partner who is leading the investor prior to us meeting to a funding decision at the funders panel. And if you are successful, the successful SME then go through the normal project setup and process with a monitoring officer assigned. And only when the investment is confirmed, then the grant offer letter can be signed off to then begin the project as per normal, where the grants are drawn down quarterly in arrears. Next slide, please. So just to close, talk in terms of what we expect in the timeline. The competition is already now open until the 2nd of July. And we are running assessment from the whole period of July once the competition closes on the 2nd of July. We will make our decision on the 31st of July, and we then only expect the investment to close after July, between August to November, October period, which is the 90 days period. So investment should not close before then, and before then we only expect it to be in late stage discussions, term sheets issued, but the investment is not closed. The investment should close within the period of August to October, which is a close 90 days period onwards, and then we expect projects to begin from November, 1st of November onwards. Next slide, please. And just to close off in what we mean by investor partner, because I've mentioned it throughout, an investor partner needs to put in an EOI form from you, and these are a selected list of 177 investor partners that we have so far. Mostly venture capitalist firms with representations from corporate VCs, angel investors, few international investors based in across Singapore, US, and Europe. Most of them are generalists. There is some specific one across deep tech and sector-specific funds. We also work with financial investors, strategic investors, impact investors, and charitable foundations. We only accept equity investments or quasi-equity investments such as convertible loan notes, ASA, the sort of stuff, and not debt finance from that perspective. We work with all stages of investors from pre-seed all the way until Series A. And we expect these investors to be elite investors or play a significant role in the syndicates. Next slide, please. And so this is more just towards showcasing of the 177 investors that we have onboarded so far. It ranged from more syndicating piece like Set Square and Haymarket to proper VC firms, as you can see here. We also work with early stage investors such as Cubis, this sort of stuff, which really shows the breadth and the range of investors that we work with as part of this program. And if you go to the next slide as well, just because we've expanded so big over the past 8 years, we have now need to expand it into 2 full slides from that perspective. So this is really just to show everyone in terms of how big the pool of investor partner is and the impact that investor partnerships have delivered so far since the inception of 2017. That's really the end of my presentation. I'm happy to take any questions.
Thank you, Raina. Excellent presentation. Yeah, super exciting to see how much the investor program has grown since 2017. Yeah, we recognise a number of those investors on your charts you presented that have worked with the Connected Places Catapult, invested in some of our ventures. We did have a question from Tom, but I think you answered it during the presentation. Tom was asking for the UK Innovator Stream, do we need to put forward a proposal with an investor already on board? It sounds like yes. Or are we putting an idea forward for Innovate UK to assess and then investors agree to support? Yes, it's that first one. Okay, but so would potentially a venture just have one investor on board, or could they have conversations with a couple?
So we use for the investor partners who typically put an EOI forward, they are kind of the late stage discussion already. So we do not expect multiple investor partners to put in one EOI for a company, because usually you reach to a discussion where if there's a syndicate of investors, the investors will know who are the investor partners within this program, of which they decide and determine one of them to put forward one EOI. There has been some instances where I received about 3 EOIs from for one specific company, but in that case, we just clarify with the 3 investors who would like to lead as an investor partner, of which for this specific program, of which they move forward with. So yeah, to answer your question, I don't expect multiple investors to put in an EOI unless it's a miscommunication.
Okay, wonderful. I'll open the floor out to questions from the audience or any of our colleagues on the call. Okay, sounds good. I've also popped into the chat the link to the Innovate UK partners list. So it looks like the latest document is the 8th of May. There's a couple of PDFs on that particular page that has a list of all the investors. Okay, great stuff. Raina, thank you so much for your presentation. If there are any questions that come up, please use the Q&A chat. And at this point, I'll hand over to Paul Lateo of Mercurio Capital.
Sorry, Yusuf, we've just had one question come in the chat, and it's actually from Paul.
Yeah, I'm happy to answer that. Paul, it really depends on the R&D research category. So it's up to 2 million for experimental development, but obviously the investor could invest more than that. So just as an example, just to give a theoretical example, I have seen a company who put forward a specific R&D project for 2 million, of which the aligned investment is to be 1.8 million, but the investor partner actually does a proper funding round of around 2.4 million, which is obviously more than the aligned investment, which is great because we want to see X multipliers of investment as a result of the grant that brings in, which is kind of a good traction piece for us and additionality piece for us from that perspective.
Fantastic. Thank you very much. So thank you for the invitation to present. Mercury Capital is a generalist broker, UK finance-based broker, and I've picked a few cases in early stage startup that we've been involved with, which are innovative, which have been resolved with innovative financing solutions, and I think could be of interest to the to this audience. Next slide, please. So we're going to cover firstly equity hybrids. We will also cover a few creative financing examples for startups, early stage, and last then a few examples that we've completed in the space, and lastly Q&A. So next slide, please. Right, so I'd like to spend a few minutes just on what we call equity hybrids, because although in all frankness we don't do them, but I think they don't get the deserved attention or the required attention they deserve. These are interesting solutions for early stage startups, and it's always good to bring them up. So for those of you which are not in economics or accounting, equity basically means cash being paid into the business, or cash being invested. However, there are hybrids, we call them hybrids, which could become the form of either equity loans, government schemes, such as Innovate UK and Catapult. That's a very good example of the government or government-sponsored or government-backed schemes, such as grants, sweat equity and sweat investment. So an equity loan basically is a loan that needs to repay. It's an equity loan, so it hits the balance sheet on the equity side of the balance sheet, but it needs to be repaid. That's the gist. Equity, in its essence, does not need to be repaid. It's just risk money. It's more expensive, but it's risk money, so it doesn't need to be repaid with an interest or with a set interest. Sweat equity is it's actually one of our favorite types of equity hybrids. So a good example of sweat equity would be someone being approached by a startup to give their time, to provide their time due to their experience or their sector experience for free, effectively, in exchange for equity. So that's a very good example of a hybrid. It gets used. I think it gets used a bit more than people understand, or than people expect. We see that a lot in startups in early stage. So yeah, I think that's a prime example of an alternative way to finance a startup. And lastly, trade incubators. So again, this I don't think they trade incubators get the attention they deserve. A good example would be, let's say you're in let's say what we call a capital intensive startup. So you need a lot of capital equipment, so equipment, plant, and machinery to produce beta, to produce pilots, to do tests. What you need, what really helps at that point is for you to have a site, a physical site, where there is the equipment, the people, the consumables, sometimes the energy connection, the energy supply to do the work. And there are trade incubators, trade sites which swap the access of those items for equity. I think this is a fantastic example of how to finance or how to bring development, so bring equity into business. It's not cash equity, it's not that kind, but it's still produces the same results. Next slide, please. Okay, so creative financing solutions. So I've got 3 here, possibly 4, that we have done, and we will bring up an example of each. So purchase order finance, advance purchase future receivables, and contract finance. These are the 3 examples that we've completed. The last one is just, again, as a reminder. So alternative finance solutions are key for startups. The UK is 10 years ahead of anyone. So Europe, continental Europe, or the US in fintech. It's not, people say it's because it's the center of finance. Yes, that is one of the items in the ecosystem, but it's also because fintech, is advanced. It's because big data had a jump about 12 years ago, 10 years ago. That generated the ability to create data that then fed into fintech, to insurtech, to insurance sector, which then was picked up by financing and fintech. Okay. So we're going to cover 3 specific examples of creative finance solutions. Purchase order finance is based on the buyer's on the buyer's strong credit profile. Advance purchase of future receivables is, I'll explain later, but it's a commitment to buy today future receivables in the future. And contract finance is a method used when there are strong guarantees involved, typically by the buyer, or we call it the debtor, so the person, the client, effectively. Okay. Next slide, please. Okay, so this is one of our favorite examples in purchase order finance. So Northumbrian Medical Supplies is a small business. They were sub-mil turnover. Their balance sheet. So in financing, we always look at balance sheets. Their balance sheet was worth about 130K, so 130,000 at the time. And what happened was they had a purchase order. This is during the pandemic, from the Irish HSE. The Irish HSE is the equivalent in Ireland, in Republic of Ireland, is the equivalent of the NHS. So it's basically the government agency for the health system. And there was a purchase order from the Irish HSE, which Northumbrian Medical Supplies won in a tender, and that purchase order was for approximately 6 million euros. Northumbrian Medical Supplies did not have the working capital required to go and buy the product and supply and perform the contract. So what we've done is we used a partner at the time called Libri Partners, which was part of Santander Bank, and we arranged the finance for the suppliers to be paid in full, for all the shipping costs to be paid in full, for the product to be sent to the UK. Well, at the time it was actually Rotterdam in the Netherlands. So the product was landed in the UK. All the suppliers were paid. The product was sent to the client on the back of this purchase order finance. This works in Principia with any startup, with any business, as long as the credit quality of the buyer or the client is strong. In the case of HSE, it's a government organization. Of course, it's a very strong credit profile. So this is a very good example. This was a very good example of purchase order finance at its best. And just to give you a quantum of how this eventually came up, the amount of financing that went into this purchase order was 30 plus times the size of the balance sheet. So in lending terms and in financing terms, this is meant to be pretty much impossible. It doesn't really work. Okay, so it was completed successfully. And Northumbrian Medical Partners, medical supply, did not have to bring in equity. So it's fully leveraged. The seller did not have to bring in equity for the trade or for the business. Okay, so this was a completely leveraged deal. Okay, next slide, please. Right, so WS Energy, this is a good contract of contract finance. So WS Energy had it was a startup. It was very much a startup. They had this system which concentrated solar photovoltaic panels, solar photovoltaic light into a photovoltaic panel. And if you can see from the picture, so as I'm sure most of you are familiar with a photovoltaic panel, what they've done is they had a patented system where there was a concentration system with special mirrors to channel more light into the panel. One of the initial problems was that the warranty for the photovoltaic panel would immediately expire because obviously the panel was not designed to work like this. So this was a pure startup at its core. The minute they touched existing technology, the existing technology would cease to have its warranty respected. So and what we've done was we help with contract finance. What when we began our involvement with WS Energia, they were literally a £200,000, €200,000 company. When we left, they were 20 million turnover. So what we've done is we helped contract finance, arrange contract finance on the back of guarantees that were given by the buyer. So the buyers were fairly large businesses in the energy sector, energy development, and solar energy development, solar energy at the time, operators, utility companies. So when these large businesses, utility companies, when they came up with a contract, we arranged the finance for the contract to be performed, and they went from 200,000 to 20 million in a couple of years, two years. Next slide, please. Thank you. So this is a bit of a short summary on a case. It's not named because we're still working on it. So this is a good example of future purchase of advanced receivables. Advanced purchase of future receivables. Sorry. So what is it? It's a UK university college hospital. There was a machine installed that treats a specialist kind of cancer, and this machine is unique. So it's a startup. Okay, so it's actually an international startup. It's not a UK startup, but it's the same. So the machine treats let's say uncurable cancers. And this University College Hospital was keen to have this machine on site. The issue was it's new technology, it's unproven, so they couldn't buy it. They couldn't buy the machine. And at this level, you're looking at about £20 million. It's not a small machine. It's a very, very large specialist machine. So what they've done, the solution they came up was to pay for the service per patient every time that a patient would be treated by the machine on site. So the machine was installed. This is a few years ago, I think 2018. So the machine was installed, And every time this university college hospital uses the machine on a patient, they pay a fee to the service provider, which is at this time the machine owner. So this is a startup which put the machine, they've raised equity, they placed the machine on site, and instead of selling the machine, they're now just getting a service fee. So what you can do, and this is on the term sheet, so it's ongoing, is you can do an advance purchase of the future receivables. The way that this works is, let's say this machine, it's now been 7 years, 8 years nearly. So the hospital by now knows that the technology works. They have an idea of how many people they process through the machine every year, how many patients, and how much it costs. So what they're now doing is they're putting into the future. Okay, so we're going to spend roughly £1.5 million in service fees over the next couple of years, in patient treatments. Could that amount be discounted to today? And the answer is yes. So what we are building is we are arranging the finance for up to 80% of that 6 years cost, which is about 9 million, up to 80% of the 9 million. So about 7.2. So the seller so two things can happen. This is why I haven't published the names yet. So either the university college hospital can acquire the machine. Now they can acquire the machine, or they can do what's called a sale and lease back. So those are the options that between the university college, so the service provider or the service taker, the client, and the seller of the machine. They're currently in negotiations. But what you can do is, when you have, again, a fairly strong client, you can look at this method. So you can say, particularly if you're a startup and you're providing innovative technology which hasn't been proved in real life conditions, you can look to get paid by getting an advance payment on the future service costs that your client will potentially run into in the next couple of years. And this is called an advance purchase of future receivables. So yeah, so these are 3 examples which we've been involved with, which are applicable for startups and are certainly unusual in terms of in traditional financing terms. Next slide, and that's it. Thank you very much.
Thank you, Paul. That was super interesting. So, I mean, I think being able to unlock the amount of investment that was so many more times what was on the balance sheet, where in usual finance terms would be improbable, impossible, but you guys found a way of doing it. That's really exciting. And then with your last example, in terms of how you're able to support the finance of something early stage, unproven, innovative, with an alternative method of being able to finance the hardware based upon a future usage, is very clever, very exciting. And I think there's there's certainly some parallels within a lot of the work that we do with some of the with the sorts of technology solutions that we have. We did have one question that came in online, which was because you were speaking about the hybrid debt converting to equity. One of the questions was, where do we find sources for hybrid debt converting to equity providers?
So that's a good question. So I think usually the traditional sources of hybrids are the same people that are in the equity space. Certainly angel investors as well, and institutional equity investors.
Okay, so it's generally the same. It's just a kind of a different approach or a different kind of conversation.
That's right. That's right. I mean, I think everyone knows the 4 Fs. So the founders, family, friends, and fools. You know those as well. So yeah.
Excellent, thank you. Any other questions from the audience or any colleagues? Okay, good stuff. Well, we are doing fantastic in terms of timing. Paul, thank you so much for joining us today and for providing your information on alternative and innovation financing. At this point, I'd like to hand over to Arnold Dutoit of WeSprint, who's going to speak about special purpose vehicles. Over to you, Arnold.
Thanks, Yusuf. Thanks, Paul. And thanks, Raina, and everybody attending. It's been fascinating so far. I feel like I've learned more than I've done in this one session than I probably have done with any other webinar. So really well focused. And Yusuf, thanks for bringing us all together. Right. So next slide, please. Quick introduction from myself. I think if you press next slide, there's a couple of features on this. So apologies. It's got some fancy features on it. So there's a picture of myself and also a picture of my father. Just a bit of a background. We're all engineers. We are also operators and owners of our own companies. We've got a nice portfolio of businesses that we span across the UK, Germany, and South Africa. As you can probably tell, I am South African originally, but I've been living in the UK for most of my life so far. So I'm quite well based here in London. So alongside our operational and sort of let's call it startup background that I have and sort of operational portfolio that we have of companies that we own, we also started investing as industrial investors. And I guess to put a bit more of a sector-specific focus on that, we look at transportation, energy, and aerospace. So we usually have a thesis on those 3 sectors, which we call sort of experience-led. So it's usually down to the careers or the backgrounds that we've had or the key things that we read at universities. So at the moment, we hold a relatively humble 200 million AUM of assets that we manage. We operate as a dual family office, I guess, and that is one title that you can give it, although we are a relatively small family office compared to some of the other players. It was also really pleasant to see a lot of the funds that some of my peers and different family office networks have invested into, and part of Raina's investment partnership. To see those funds on there, I thought it was really great to see that the likes of Empirical Ventures and those guys are on the platform and they're celebrating that. And I think they've already closed some deals with those guys before. So definitely would advise this all the startups listening and the investors who are on the call to participate on that front. Next slide, please. So a little bit of a bit more thematic approach that we have, but we've broken it down into something we call FACE. So as I mentioned before, we're investors, but we're also venture builders and owners and operators, but we also manage our own funds and help manage several other funds which are part public and privately owned. And we have a very simple mantra. It is we fund capabilities and capacity. Usually you find that you fund capabilities more at the earlier stage and capacity when you start to get to that sort of late stage growth. But we also acquire technology and influence. And what I mean by influence is we acqui-hire. So we hire people from large organizations to have more specific or sector specific knowledge or contacts within that realm. And then what we then aim to do with our portfolio eventually is to consolidate or at least form companies that help us consolidate some of those values that some of those technologies and influence that we've bought in or acquired. We try and consolidate them into a format that we can then exit So we don't look to just sell individual assets. That is obviously always something that we would be up to discuss, but mostly we look at acquiring technology and influence, consolidating those and wrapping them up and exiting for a slightly lower return than you would do if you were selling startups or rapid growth companies. But it's worked for 3 generations for us so far. So we call that rapid impact deployment. So the faster we can get to the impact deployment of what we acquire and fund, the better for us. So next slide, please. Sorry, the green circle's kind of a bit funny, but hopefully you can see that says special purpose vehicle. The topic that I'm going to talk about today is different to what Paul and Rainer and Yusuf were talking to right at the very beginning. This is more of about a mechanism that is available to all organizations across the world and has been used for over a century to get to that rapid impact deployment stage. So you all might have heard of something called an SPV, and most people would have heard of SPVs from a financial point of view, where you can syndicate a group of investors or organizations to fund a particular project. But in this particular instance, I'm talking about a slightly different version of a special purpose vehicle. The concept that I'd like to put across is startups usually are good at one thing, especially those that are hyper-focused, and especially in our industry, when you look at the energy and transportation side, usually founders come up with a particular technology solution to solve a particular challenge. But most of the time, the people who acquire these technologies are large systematic-based solution companies, and they usually buy in these small technologies or license these technologies to fit part of a bigger supply chain. Now, the idea of forming an SPV, if you're a startup, in this particular instance, is to assume the supply chain that you're selling into and to try and make sure that you are, if you're one part of a larger supply chain for that solution to deliver that rapid impact deployment, maybe it'd be worthwhile to look at your competition more as partners, or potentially look at technologies that are synergetic with yours. And the aim here is to solve large, complex problems, which we are all facing in the sectors that I mentioned before. So especially in aerospace, you see a lot of this kind of what we call technology stacking. A group of technologies that get together, form a slightly larger solution than they would have done by themselves. And under clever commercial contracts, these special vehicles can be pulled together to offer a low-risk, commercially focused entity for investors or clients to acquire. So the idea here is, if I can give you another example of how to use an SPV, you have a piece of technology and hopefully you've got some protection around that technology. Some people might have patents or design rights or copyrights around some of their systems and hardware and software. But let's assume you've got a really good piece of intellectual property on your balance sheet. You're an early stage company, so you're obviously looking for a bit of market fit, or maybe you might be well market fit and you do have a stable environment. You need to raise capital, and you need to raise capital either to build your business or to diversify your product range, or create further moats within your business to protect your future growth. One of the ideas that you can, or commercial opportunities that lay ahead of you, is to license your technology as well as build your own business. So some companies, what I call full fat startups, is you come up with a concept and you develop that concept all the way through to manufacturing or serviceability, and then you sell it to your clients. So you do the full end of invention all the way through to innovation, which is you selling your product globally. That is something that some companies do, and that is quite capital intensive in certain industries. But there's also a different solution for commercialization, which is licensing that core piece of intellectual property. If it is so unique and so valuable, you can license that under a contract to a manufacturer to then resell, or to a distribution network of sales companies. So licensing has been around for a long time, but the idea of technology stacking and forming an SPV to which you license your technology alongside other technology providers, and also combine potentially public and private organizations within that SPV to form a specific solution for a larger systematic problem, is a great way to shore up that value of your intellectual property on your balance sheet, as well as provide an investment vehicle for investors who are not interested in the same risk that an individual startup might carry. These risks could be, runway expectations, the amount of capital to fund R&D, and there could be a whole history within certain startups that just sit outside of the risk profile of what investors might look at. So this opportunity of forming an SPV alongside other technologies, like I said, creates a technology stack to solve big problems. Bringing in other partners, whether it's public or private, gives a great opportunity for you to remove some of that risk and offer a commercially focused entity to an investment network. So what I've got here on the screen is, on the left, you've obviously got the makeup of these special purpose vehicles. Some of them could be called joint ventures. It could also be contractually bound and not put into an entity. But the point here is you've got technology partners working together, and then you have other organizations that make up that solution. Like I said, it could be both private or public partners that you bring in. Just one point on the public partnership here with an SPV. What we like to do as investors is look at the total cost of ownership, but also the utilization of our assets. It's really important for us. We call it, the return on total assets, or how well you are utilizing your assets. Now, the public sector has an interesting problem, especially here in the UK, where they own or operate big assets. So these can be roads, car parks, rivers, shorelines. It could be locations as well as products or places or infrastructure. And those assets need to be utilized or at least innovated on. So the reason I sort of add local authorities and central government to this pot of the SPV is that if there is a opportunity to invite a public resource, or like I said, an asset into your SPV and build a solution centric to that asset to help commercialize it, that is a way of potentially also looking at leveraging public funds as well as private capital. So in general, forming a technology stack into an SPV allows you to de-risk that that asset and focus on the commercial pathway forwards. But also, like I said, it could be a really nice blend between public-private partnerships moving forwards. And it's highly underutilized, this particular mechanism, for most startups, as obviously you're too busy building your own businesses and probably don't understand the complexities or the opportunities that sit within those complexities of going commercial. So I'll move on to the next slide, please. So I might have touched on this before, but just to reiterate and just give you a simple analogy here is, so why technology stack into SPVs? Why is it good for rapid impact deployment? Well, there is a fragmented ecosystem trying to solve things across transport and energy. And the idea here is for technology providers and as I said, asset owners and holders to work together to create a more collaborative approach, but also collaboration sometimes is hard to fund because you've got multiple different entities. So the idea here is to form an SPV to create one aligned scope, to allow investors to invest into a simple equity deal or use different alternative financing options like we've heard of today. The idea of aligning a fragmented ecosystem is something that everybody works on. And as I mentioned before, one of the key areas you see a lot of this kind of technology stacking is obviously the healthcare space, the energy space, and also the aerospace sectors, which we have dabbled in before. There are lots of smaller players that make up bigger systems. And once again, the idea of realigning and creating an entity that can take investment and grow commercially is quite attractive from that point of view. So this diagram just shows you a kind of fragmented to a more aligned future with commercial focus. Next slide, please. So you don't just have to hear it from me. So forming these technology stacks, we have done this before with a catapult. So we built 2 SPVs, or at least scoped 2 SPVs for a hydrogen energy specific program that we ran at the catapult. The kind of first of its kind, where we set out 2 challenges, one upstream and one downstream, and we wanted to utilize a huge asset in our capital, which is underutilized today, but used to be massively utilized back in the early 17th century, which is our River Thames. So the River Thames offers a huge opportunity for last mile or mid-mile distribution, but at the same time, inland waterways and inland vessels that we can use alternative fuels, things like hydrogen or different forms of gases to run those less harmful propulsion systems. So we thought, well, why don't we build an SPV, 2 SPVs that serve each other and allow for a lot of technology that's finding it hard to break through commercially to create a commercial entity which they can license or participate into and earn from, and also value their businesses where there is very little validation in the market available for them. So we set out to raise a hydrogen conversion and distribution infrastructure consortium. That consortium was then scoped into a company. It was made up of several different players, and we did the same on the last mile side, where we reinvented a river-based and land-based sort of fully integrated system for last mile and mid-mile delivery on the river. We went out to effectively almost like a competition where we advertised the 2 challenges, and we sort of gave a headline of what type of technologies we were looking for. And the response was relatively vast. We had over 100 applications for these SPVs, where interesting technologists, individuals, academia, larger corporates all proposed an offering to the SPV. Not all of it was technology based. Some of it was sort of human resource based. So like I said, some academics joined the program where there were sector specific interests, and they wanted to bring their knowledge into the SPV. So that is a person coming on board instead of a technology stack, for example. We also had large corporates with vast systems available that could also serve some of these SPVs, or at least provide some of the fuel, or again, provide some of the vehicles that they might have, which aren't applied in this particular context, because they're also looking for asset utilization on that front. So these are the 2 SPVs we run. It was very successful. I'm just going to quickly show you and give you an idea on the next slide on the scale of the opportunity, or how this allowed you to grow commercially a lot faster than the usual track. So if we can go to the next slide, please. First one was our upstream SPV. So we looked obviously at hydrogen distribution on the riverside. We worked with these 2 wonderful companies, Rhizome and Unitrove. Both businesses were going through an enormous amount of R&D, as you can imagine, some of which had market fit and were already trading on Rhizome's front. So they were already producing technology within the hydrogen space and selling it. However, they were finding it incredibly hard to find more commercial projects available for them to grow their revenue. Unitrove on the other side, slightly more earlier stage business, but looking at a much bigger concept around bunkering of hydrogen technology. They were in the depths of R&D funding and had taken multi-million-pound grants and investments to be able to get their product to market. And they had a really well-established portfolio of intellectual property. But like a lot of companies that we see that take on huge capital-intensive R&D projects, finding investors to keep backing that risk is difficult. So they were finding it incredibly hard to find a commercial validation to show investors that their technology was commercially viable. And so bringing these 2 SMEs together in a form of matchmaking, we brought a proposition for hydrogen for this river last mile logistics client, so to speak, the SPV2. We brought them together and we sort of looked at some of the impacts from a financial point of view, and also from an impact point of view from a mission side, and what the difference would be like with or without this type of technology stack SPV that we proposed. So on the bottom right corner, slightly dull, but the revenue from the SME, which was projected, combined SMEs projected, was around 70 million by year 5. If they used an SPV for a commercial vehicle, the revenue that they would pull in from that SPV would sit around 50 million on top of their 70 million 5-year forecast as additional finance that would come into their companies through licensing or providing technology and people to the SPV. So you can see a huge increase in potential future earnings, and it was done through this kind of small vehicle that they are a stakeholder of as it grows, and obviously is commercially focused, much more attractive for the investors to be on board in the SPV as opposed to taking the risk on the SMEs that are quite difficult. Same with the impact, at the same time as these companies grow and scale their own solutions, as they would have done without the SPV, we had a sort of 8.1 million tons of CO2 removed by year 5. But obviously we also had the same impact level for the SPV production and what that would replace for inland water fuels, using hydrogen instead of diesel to run some of those vessels. And obviously you can see, again, you combine those 2 impact metrics and suddenly the company can start to promote numbers that really attract investors, not just from a revenue point of view, but also for those impact investors looking for that environmental impact return. So this was SPV1. If we can go to slide number 2, I can also show you the same makeup. 2 brilliant businesses who worked together when it came to the last mile logistics system. We had a company called Hubble with their product Cool Run, but also a huge amount of knowledge in last mile and mid mile logistics. And then we had an academic project called Picking Up, which was academic students working together on using AI to further develop that kind of efficiency around door-to-door dropping of fresh goods. So Cool Run as a product, just to give you perspective, this little SPV was focusing on using the river to help bring in perishables. So think food and beverage industry, bring perishables into the centre of London, where usually that is quite hard to navigate and also energy intensive to get to its location quickly. So these two companies really solved that problem. And again, you can see the kind of split between Hubble and Pick and Run's projected income over 5 years compared to the revenue that they would then also add to that through the SPV. Quite phenomenal numbers, and also that forecasting on the CO2 savings per year as a tonnage is incredible, that they now meet those kind of targets. So overall, the concept is by yourself, you can do a lot, but if you come up with clever commercial opportunities to collaborate with technology, people, and like I said, public and private organizations, the opportunity to create your own commercial project and put that into an entity that could be run as a business by itself to solve a specific problem is a great way for you to scale a commercial opportunity and also attract investors who are looking for commercial de-risked assets to invest into. So that is it from me. I believe the next slide is the Q&A. If we can go to the next slide. Well, yeah, thank you very much, Yusuf and the rest of the Catapult team, and I hope everybody enjoyed that. Open for questions.
Thank you, Arnold. Fantastic to hear more about WeSprint, the family office, the projects and initiatives you're getting involved in, and see these, these real examples of the benefits of SPVs in terms of economic value add, but also non-financial returns as well in terms of emissions. Great stuff. I think we have I think I saw a hand up from was it a hand up from Phil on the call? Let's have a look. It was either a thumbs up or a hands up.
Oh, that was just a mistake. I wanted to thumbs up and press the raise hand.
Thank you, Philip.
So, any questions from the audience? Okay, wonderful. Any thoughts from Paul? I think you're muted. Are you still on the call there, Paul? Because I know that SPVs is something that you've done a bit of work on as well. Have you seen this kind of approach as well with newer technology, early stage innovative technology as well?
Yeah. So I used to be in project finance and energy sector, so SPV is very familiar. So my question was would the use of SPVs reduce the capital needs in cases where there was a working capital intensive or a CapEx intensive startup? Would an SPV, how would an SPV be inserted there? And would it reduce capital requirements?
It's a very good question, Paul. So I want to be able to say yes, it would. But looking at its primary use, if you have a capital intensive startup with decent intellectual property, and let's just make it a little bit simpler for ourselves. Imagine the technology is granted and therefore can be licensed as what we call a licensable commercial data pack that this company could offer. If there was little to no commercial market for that potential licensing to occur, then forming an SPV could allow that company to validate or at least value its technology and create its own commercial project in an entity that can then also take finance or take funding. And there's an opportunity, I guess, not to help with the capital intensive nature of the startup, but at least increase its valuation, which will probably allow it to raise more money for better valuations, where that commercial project is then used to validate, commercial success and offer market fit. It probably also allows an investor to truly see from a commercial perspective the capability and capacity value of the company as well. So not just the startup and its technology and its intellectual property, but the people within that company and how they work with their network to create these technology stacks. So if they've got the ability to think systematic, therefore they understand their client base very well, and they can understand the innovation within supply chains, but they can appreciate that a lot of large organizations do not want to disrupt that supply chain all in one, and therefore new technologies find it hard to fit in. If they were to create their new supply chain with a systematic approach using an SPV, then I guess that would help with the capital intensity, because I guess you're offering a true valuation based on a commercial project, again, allowing them to raise at better valuations. And capital intensive companies turn into incredibly diluted cap tables, in my opinion, after sort of 5 or 10 years of maturity, when that technology finally is developed and out in market. And you do find that the original incentive from an equity perspective has diminished over that time. So you've got a lot of dilution, you've got a lot of interesting different shareholders and investors, some of which might be dormant compared to those that are more active. And I feel like that's also a valley of death. Companies with really heavy cap tables and still no commercial projects are really hard to navigate from a capital, from an investment point of view. Because what's the incentive if you come in and you take 40% of a business that's 10 years old? What is the dilution for all its original founders and previous investors at that stage? And I guess valuations then become hard to digest too. So I hope that kind of helps, Paul. It's a way of, I guess, increasing valuation at these capital intensive companies.
Interesting. Thank you.
And
And because obviously Arnold's done a fair bit of work with the catapult and the first tech stack competitions that we ran within the catapult within our freight innovation cluster and fund. They were in partnership with WeSprint. So based upon some of the organisations that you've seen, and you mentioned a couple. Is there particular organisations or types of organisations or solutions that would be a better fit for an SPV than others?
So it's a very good question. I like to think that there's this wonderful division of hardware and software if you look at the transport industry. So there's a hell of a lot of large, expensive assets that are used within freight and logistics. And the innovation to disrupt that market it's really hard. It's really hard to break through. It's really hard to raise finance if you're a hardware producer within that market, because as I said before, their supply chains are old, they run at really low margins, and therefore these companies find it really hard to innovate with new hardware. Because a hardware product in a big logistics system is part of a supply chain. So therefore there's risk carried with new technology being brought in to disrupt that supply chain. So what we see as good partnerships and what we've seen in the freight technology stacking competitions that we've run now, I believe now for 3 years, and they're quite well funded. So definitely look out for new technology stack competitions coming out, I believe, over this year with Catapult. The good matches we found are software business who look at data aggregation and utilization of certain logistics or freight networks. So almost creating a marketplace for people to utilize parts of the freight industry that aren't utilized enough. So you've got a lot of route optimization technology that is then turned into site AI management tools, and these tools are then sold to the industry. But the efficiencies gained by that has kind of been expected, and some of it has been met. And the only last bit of efficiency that you can then start to inherit to open up those margins is looking at that supply chain hardware in the industry, or maybe the energy fuel used to run that particular logistics train. So what we found is good matches is these software businesses that sell into the freight network, they get to a slightly saturated market point where every single freight logistics business is using a different type of AI around route optimization or charge maximization, or even looking at fleet transition for energy. There's so many different software providers with no edge. So the scale of growth for those companies is slightly stifled because everybody's using their own system and keeping that data within their logistics company. So what we found is some software companies partner up really well with some of the hardware businesses because these software companies have a better understanding of where that disruption for the hardware could fit. And usually it's a capacity issue at the client side where they don't even understand how to integrate that tech. But a software company with good data can help that company understand the transition from going from diesel to electric, or mobile charging solutions for energy storage. All these things are complex technologies that the freight industry sadly just hasn't got the capacity to absorb. So we see good partnerships between software and hardware businesses that partner up and create a very bespoke solution together to solve a particular sort of systems-based problem at logistics and in freight. And those happen often across all the different modes of freight. So, we've seen equal technology stacks within rail, the maritime space, and within road distribution.
Wonderful, thank you. That's really interesting. Really, I'll continue to think through how we can support our ventures, our SMEs, with these different approaches. Arnold, thank you so much for your presentation and for taking these questions as well. Great. Just next slide, please, because we're almost at the end of our session today. So just as a quick recap, the Investor Partnership Programme, it supports UK SMEs by combining R&D grants with equity investment to accelerate innovation and address the challenges of capital access and inclusion challenges. There's a round open at the moment, which looks towards UK's net zero transition, includes clean energy, sustainable mobility, low carbon manufacturing, and food systems, of which these areas are of scope to Catapult. We then had our session on financing innovation, which explored how innovative financing solutions for startups focusing on equity hybrids and creative finance models. These sorts of finance models include things like purchase order finance, advanced receivables, contract finance. And it was interesting to hear about the additional finance methods emerging through big data and how we had a competitive edge based upon our big data from a number of years ago. And then finally, we heard from Arnold of the Dutoit Family Office, the advisory firm WeSprint, who invest in industrial deep tech sectors, transport, aerospace, and energy. And we heard about their approaches in putting together special purpose vehicles to bring together multiple organizations and providers to be able to have investors invest in a solution, in an overall solution, rather than one particular product or technology. With that, I would like to thank our speakers today, Raina Lim from Innovate UK, Paul Latio from Mercury Capital, and Arnold Dutoit of WeSprint. I'd like to thank the Catapult team and our events team for helping put this event together, and of course our attendees and participants today. Thank you all very much for joining, and if you do have any questions or any follow-ups, please contact the SME team. You can contact us through the website or speak to myself or one of the speakers. You can connect with us on LinkedIn. Enjoy the rest of the week. Bye for now.